Well, a hotter than expected non-farm payrolls number and what appeared to be intervention in the Japanese yen dominated financial markets last week, with treasuries continuing to sell off aggressively at the long end of the curve. Those stocks managed to notch a modest weekly advance, and the dollar snapped an 11-week winning run. A dose of geopolitical risk has been injected into the markets after weekend events in the Middle East, as traders look ahead to the US inflation figures later on in the week, as well as the start of second quarter earnings season. There's plenty to discuss in the Trade Off UK this week, so without further ado, let's get into the show. Well, all told, it only took me 5 takes to get the intro to the show right this week. So before I make any further mistakes, let's bring in someone who can hopefully rescue me, Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, come on, you're going to have to take the reins this week because it's all descending into shambles over here, I think.
Yeah, I don't know what's going on, mate. It seems to be all falling apart over where you are, and on more than one front, as we were discussing before the show. But yeah, go on, get it out of the way. I know you want to. You put it in your notes probably 30 seconds after the NFP report. So come on, let's hear it.
Oh no. We'll get onto that in Topical Thunder.
Okay.
I want to do this properly, Ryan. So we've got to do it justice. So let's get into the payrolls number and Topical Thunder. So, yes, of course, the non-farm payrolls number. Where else can we start after that big surprise that we got on Friday lunchtime? And, well, Ryan, it was quite a surprise for you, wasn't it? Where was your guess at?
I guessed minus 150,000. So what? I'm not a sheep. I'm a shepherd. I like to lead the way. I like to be out there sometimes, which, bear in mind that you put your guess up as usual 2 minutes before the actual number dropped, after the ADP, after you've seen all the PMIs, after everything else. When I ask you on these shows on a Monday when we have NFP, what's your guess? Oh, I don't want to do it. I'll do it later in the week and blah, blah, blah. So, yeah, I picked minus 150. You were still light ways away. Anyway, what was yours? 160,000. So,
yeah, 160. I mean, at least I was on the right side of zero. That's my only.
Oh, well, if you're classing that as a win these days, mate, there's no hope.
Oh, you've got to take any victory you can get, mate. More seriously, it was a pretty impressive jobs number on Friday, certainly more impressive than both of our guesses. Payroll was coming in at 336,000 in September, which was well above all the estimates that have been submitted to Bloomberg. And you've got to add to that, of course, around about 120,000 net upward revision to the prior 2 months worth of data, which is even more impressive. So a very, very solid pace of jobs creation. No sign of any cracks emerging there. Some of the other areas of the report were a little bit cooler. Unemployment remaining unchanged at 3.8%. Average hourly earnings also flat on the month at 0.2%, exactly where they were in the month of August. But I think, Ryan, the most interesting thing for me, apart from chuckling away at your guess on Friday afternoon, was the market reaction, because initially you saw what you would expect on a blowout payrolls number. Equities coming lower, the dollar rallying, treasuries selling off, led by the front end. But then, I stepped away from the desk for an hour or so, came back, and all of a sudden, the dip in equities has been bought really aggressively. Treasuries have retraced half their losses. The dollar is pretty much back to flat on the day, and the market hadn't really repriced its Fed outlook in too hawkish a direction. So what on earth do we think was going on there? I mean, my first assumption was it might be a bit of profit taking, it might be a bit of positioning after the number. But do you reckon it's that, or do you reckon there might be something more at play?
I think, take it in several parts. Obviously it was an outlier jobs number, outstanding jobs number, and those higher revisions broke the back of the lower revisions that we've seen. And we'd seen, jobs coming down steadily, 400s, 300s, 200s, 100s, and then boom, we're up in the 300s again. So I think there's a little bit of skew in there potentially as well. There was some talk that government jobs, teaching jobs, and that sort of thing that had dropped out previously had come back in. But I think overall, what the market reaction was tends to tell me that we've had this 2-week period of pricing higher for longer. We spoke about on the show the market waking up after the other reports and other data that the US isn't going to be crashing and burning, so the higher for longer is going to be in play. That was after the FOMC, you remember. But, I think the market's probably got as high as it's going to get in terms of trading that. So we can call it pricing it in. So I think the market is pretty much priced in now that we're going to be higher for longer. We've seen that move coming over the last couple of weeks with yields going up. And it's going to take now, I think, some extraordinary strong data to get the market more hawkish, to get the dollar, further moving higher and yields moving higher. So I think we've had on the data front a bit of a top put in play in terms of how much this data's come through the market. And that's what I think it is. But yeah, maybe a little bit of profit taken on top as well. But yeah, I think the market's fully priced this higher for longer for now.
Yeah, it's certainly an interesting one. Of course, we're filming this Monday afternoon. Treasuries or cash treasuries are closed today for Columbus Day, but it'll be interesting to see how they do react when trade reopens tomorrow morning, particularly after obviously the geopolitical developments over the weekend in the Middle East. That may add some further demand, particularly at the long end of the curve, which could just reinforce that idea that you just put forward that we may have seen a bit of a short-term top on a yield basis at least.
Yeah, and futures are open, and if you look at that sort of pricing, we've got yields around about 10 years, around about the 4.7s. So there's been a little bit of a drop back there on the situation, obviously, that we've seen over the weekend. But yeah, when trading is going to be a bit light today with half the market shut, so tomorrow when you see this, it might be a bit of a better reflection of how that's all been traded. But yeah, overall, we've had a high put in yields up at that 780s. So that's really our marker there. We've had two little touches up there, and now we're back below. So that's going to be our marker moving forward, I think.
Absolutely. And we will be watching that like a hawk. Something else we're watching like a hawk is the 150 handle in dollar yen, isn't it? After what happened last week.
Well, how apt, in my piece last week, my topical thunder piece, we were talking about the intervention and whether we're close to it and what they're looking at. And they seem to blow that all out the window. We were getting more concerned about whether they were looking at the level of the yen. And, firstly, I've never seen jolts move a market quite like that before. 200 to 300 pip move after the jolts number.
Well, it just gave the market a bit of a jolt, didn't it, at the end of the day?
Yeah, exactly. Oh, these Christmas jokes already.
Come on, keep up. That was a good one.
Whatever the reason, the 150 break in dollar yen got someone interested. And from that point, the pair got smashed down to, I think, 147.30. Then we saw a quick recovery back to the 149s, obviously a bit jumpy in between. The Ministry of Finance, Bank of Japan officials have been very coy about whether they intervened or not. Even that morning before that move, Suzuki said the level of the yen wasn't important and that volatility was. Well, a 30 pip jump over the jolts report through 150 wasn't exactly a volatile move, but still apparently someone acted. Since then, we've had a bit of clarity after the event, really. Their chief FX man for the government, Kanda, said that excessive volatility wasn't just classed as a move in a day or a week, and that big one-sided moves that accumulate into very big moves are also classed as excessive volatility. So it was a bit of a change in their definitions of volatility. As for who may or may not have intervened, it's likely the MOF had a hand in there somewhere. But they could have used an old tactic of getting some of the big Japanese pension and life insurance whales to do their bidding, if you like. It's something that they used to do. And thus keeping it off the Bank of Japan's official or the Ministry of Finance official intervention books, if you like. And it could have also been a bit of market panic. We know that there were a lot of eyes on this 150 level as an intervention point. Perhaps it became a bit of a self-fulfilling prophecy. We knew there was a big barrier there as well that was getting defended. So really, we're only going to really know one way or another. Well, I say one way or another, if it's definitive they intervened, when we get the intervention report, the FX report from the Ministry of Finance late in October, early November. But what that's done for dollar yen is now sown some cautiousness into the price action. Rallies are likely to find tougher resistance, especially back up to that 150 level. But the fundamentals still prevail for buying dollar dips, at least on the dollar and the US side of things. So from here on in, I'm expecting a bit of calmness to come into markets. But I'm expecting, as I say, rallies maybe to suffer a bit.
Yeah, very much so. I mean, I think the high that we saw in dollar yen after the payrolls number was about 149.50, and we have just been kind of 50 pips either side of that 149 handle pretty much since whatever it was, whether it was intervention, whether it was jawboning, whether it was a rate check, a nudge to someone here or there on Tuesday afternoon. We have just kind of trod water around that 149 mark. But, it comes back to that point we made previously, either last week or the week before, in that, you've got a government that is trying to prop up the value of the currency at the same time as you've got a central bank in the Bank of Japan that is not doing anything to tighten monetary policy. And of course, this big treasury market sell-off as well. So, the government are trying effectively to work against where the macroeconomic fundamentals would say dollar yen should be trading. So I think this is, whatever it was, has very clearly marked 150 out as a bit of a line in the sand now. But I would expect the market is going to have another go, have another test, and then we get back to really where we were almost exactly a year ago. They've intervened once, it worked short term, but then we've come back to the same level. Do they intervene here? Do they let it go higher? And we're really all left scratching our heads and asking the same questions that we were a few weeks ago.
Yeah, exactly. And as I say, that that 30 pip move that we got over the jolts number and then the trigger. Typically, I was in a trade that I managed to tick the high of that whole move with a buy stop at 150.15. But I think the best part of that whole trade is that I actually got stopped at my stop level, 149.75, rather than gapping down to 148 or something like that. So I'll take that as a bit of a win. But they say they weren't interested in the level of the yen, yet it took a 30 pip move through 150 to get something happening. Again, we don't know if it was them, it may be them, it's likely them, but we don't know. Either way, that focus on the 150 level is going to be huge now.
Yeah, absolutely. And, it's not just a focus in terms of traders who are long, it's also a focus of, are you now going to get people trying to position themselves to front run potential intervention if we do break north of 150? So you've probably got a bunch of orders between, 150.05 and 150.20 just lurking, ready on a break to short dollar yen, in the hope that the Ministry of Finance step back into the market.
Yeah, and that's dangerous in itself, because you can't be you can't be short dollar yen for any great amount of time, because it just costs you too much money on the carry. So, if we have got people trying to front run it at those levels, you get to 150, 60, 70, 80, those people are going to be running to the hills, which is then going to propel it higher potentially. So it's a very difficult situation to trade this. They've sown the seeds of doubt in the market's eyes, got it a bit more nervous, so things could be a bit more jumpy.
Absolutely. Right. Well, we could talk about the yen all day, I think, but we're probably not allowed to. So let's move on, because looking ahead to this week, we've got, quite a quiet economic calendar, actually, in all honesty, besides just a ridiculous amount of central bank speakers, most of them having a free holiday in Morocco. But in terms of the economic data, it is the US inflation data that is by far and away the most important release that we have this week. The CPI print we have on Thursday afternoon is really the next, and actually probably the final piece of the jigsaw, really, in terms of determining what the Fed are likely to do at their next decision in the first week of November, the 1st of November, I believe it is. But before getting to that, what's interesting, and I've got to give a little tip to Arno Venter down in South Africa for pointing this out to me yesterday, market analyst. This month, interestingly, the reverse of what we usually have is that PPI is coming out on Wednesday. We usually get that the other way round. So we could get a little bit of a lead on whether we're going to get a beat or a miss on the CPI print from what we get from PPI on Wednesday. So just bear that one in mind. We could see some traders position for CPI based on what factory gate prices come out as on Wednesday afternoon. But of course, the CPI print is what we'll all be watching. We're expecting a modest decline in headline inflation, down to 3.6 from 3.7% prior on a year-on-year basis. That's pretty much all because of the impact of the big crude rally that we saw over the summer, beginning to drop out of the numbers a little bit. So the month-on-month rate is set to fall to 0.3 from 0.6% prior. The core number set to remain around 4%, 4.1% is the Bloomberg consensus at the moment. moment. Now, all of this is obviously much hotter than the Fed would want, but I think it's still pretty clear evidence, particularly on the core number, that the US is still in this disinflationary process. And I guess the real question, and we were alluding to this earlier, Ryan, is, how hot does the inflation number need to be to, one, give bond bears even more ammunition to keep shorting the hell out of the long end of the curve? And secondly, how hot does it need to be to get markets to really strongly consider the fact that the Fed may hike in November? I think that's currently priced at around a 1 in 3 chance. It's about an even chance that the Fed hike by year end, and the first cut is currently priced for July next year. Personally, I think although I think there is a decent chance the Fed will hike again this year, I think it's probably going to need a very, very hot inflation number in order for the market to come round to that view this week.
Yeah, I agree with that. And, we've got to think, if we do get a higher than expected CPI number and higher than last month's 3.7%, there's going to be 3 months now that we've seen higher CPI numbers. That's now a trend in play. You can pass off 2 numbers going higher if you get the third one coming down again as expected. So, yeah, if we do get a higher number, maybe 3.8%, 3.9%, then the market is going to be fully slamming into rate hike expectations for that November meeting. But again, we've got that core number, which has continued to slide lower. If that keeps on coming lower, then the market's going to think, well, maybe it's going to pick up at some point, but not quite follow the headline, because the core tends to lag. But if that goes up as well, if we get both numbers going higher, then yeah, we're going to be fully turning around those hike expectations, probably getting the other way. We're probably 2/3 expecting a hike after that point. We saw it happen before the last FOMC meetings in terms of how quickly market expectations can change. We went from, for example, the ECB went from then pricing nothing to pricing something, then from the Fed pricing something to pricing nothing. They flip around very, very quickly at the moment because that's the market trying to guess it. But I think longer term, we've already seen that push out of the first cut, to September from July after the NFP. That will come into effect as well. That will probably get cemented again on stronger numbers. But if the numbers are softer, if inflation is looking like it's coming down, then we're into the soft landing trade once more. The Fed are getting their wish, and that hike stays in the back pocket.
Absolutely. One thing I do think is interesting, just before we move on to growth, in terms of the Fed, is just this, just anecdotally, there seems to be a lot more talk from Fed speakers. And I know we go on about how boring it is to listen to them, but listen we must. We heard from Daly last week, and we heard from Logan, actually, 2 minutes ago, but while we've been recording. Both of them are talking about financial conditions and how important it is for the Fed to take account of financial conditions when setting policy. And I think Daly actually last week basically went as far as saying that the sell-off we've seen at the long end of the curve is almost doing our job for us in actually delivering another 25 bips or so worth of tightening. And if you look at financial condition indices, Goldman produced a very good one. You can pull it up on Bloomberg or Reuters. I'm sure it's freely available somewhere. Financial conditions are actually at their tightest in about 10 or 11 months, since kind of November last year. And when you think about that, and you feed that into the policy-making discussions, the Fed are going to be sat around the table going, well, conditions have tightened pretty significantly anyway. We know they're going to tighten further next year, because if you hold nominal rates steady and inflation comes down, real rates are clearly going to move higher, which will generate more restrictive conditions. Do we really want to deliver another rate hike on top of that and kind of double down? If you're a hawk, you would say, yes, we need to really make sure inflation is dead. If you're a dove, you would probably say, well, hang on, as you alluded to, let's keep that hike in our back pocket just in case we really do need it in December or maybe even early in 2024. So that may just be tempering market expectations a little bit in terms of that hawkish repricing, I think.
Yeah, and then you've got the likes of Mester who are all but going to vote for a hike at the next meeting, apparently, because saying that if the data carries on conforming to what's happening, if it's not changing at all, then a hike is on the table. So I think we're probably closer to a hike for some than others, but I think they keep it in the back pocket, definitely, just in case we do get higher inflation coming through the pipe. But as I say, this CPI and PPI reports are going to be important for that.
Yes, very much so. And also, of course, the other important part of the equation is what's going on the growth side of things. And what a segue that is. It's like we rehearsed this, mate, honestly.
Smooth. It's like butter sliding into one section to another. Yeah.
Or as smooth as your head.
Listen, Mr. Penalty Spot, if you want me to go there, I can go there. But there he goes. Look, you just caught a glimpse of it there as he bent forward. So, let's leave that where it lies, shall we? And let's talk about global growth, shall we? Because we have got this, I've called it the race to the bottom. We were playing the growth trade on the way up. Now we're playing it on the way down. And so we're well into the game and the race of who's going to be the first economy to trigger rate cuts. So it's worth having a look at where the runners and riders are actually currently placed. Obviously, out in front, and this is among the majors, is the US. There have been some negative signs in small doses, but overall, as we saw from the jobs numbers, the Yanks remain in good shape. Hence why the dollar remains the currency of choice and yields there remain high. Next up is Japan, who I'd put in second place here, currently in second place. They're not doing too bad either. Inflation pressures remain, but the economy is ticking along also. And if this theme continues, we're going to be getting closer and closer to all the boxes being ticked for a change in Bank of Japan policy. Now, this is going to be not them cutting, but them hiking. But that may bring the yen to one of the tops of the pile because there's going to be some hefty strength behind that rather than more weakness. Then we've got Canada. They may have a bit of a flat GDP picture at the moment, but the data seems to be turning up again, at least in inflation and jobs. A moderately, strong jobs picture again from Canada on Friday showed that continuing. I'd also put, Australia and New Zealand in that same pack as Canada because their data, nothing falling off a cliff, and some signs of progression, jobs, and again in inflation. So there or thereabouts, Canada, Australia, New Zealand, all close together. And then next, you've got to look at China because despite a ton of negative headlines that we've had, and by their own standard, things have been slow, they are still aiming for over 5% growth and for the year, and you can't really knock them not getting that or close to that, and it'll still be much higher than pretty much anywhere else as well. I only think the risks to that are this geopolitical spat continuing between the US and whatnot, and that decoupling that we're seeing between all these countries, that might be their bigger problem now. And coming up in last place, as you may expect, is currently the Eurozone and the UK, both flatlining on the growth front, but not in any real need of real resuscitation just yet. But of all the runners on this list, I feel they could be the countries or the areas that are going to need some easing help first, and that's why they're bottom of the pile. And looking at it for trading wise, we've spoken about it before. Whoever's going to be the least dirty shirt in the pile is going to see their currency gain, and we're going to be playing the divergences between those.
Absolutely. I really rarely to say this, but I struggle to disagree with anything you've just said there, mate. I think the only thing that I may just take issue with is obviously
So
China.
You're going to disagree with something then?
I am going to disagree with something now. Having said that, you knew it was too good to be true, mate. I mean, the only issue I have is obviously China. We've got no idea what's going on within China. Let's be honest. The government will say we're aiming for 5% GDP growth, and 12 months later, well, I never. They've achieved 5% GDP growth, and next year they'll say we're wanting for 6, and guess what? They'll achieve 6. So I would take that with a huge pinch of salt. I think the one difference that perhaps is impacting the Chinese economy is the structural issues that we know are very, very well documented. They're trying to move to more of a westernized economy in a way, in terms of being dependent on services and discretionary spending and that sort of thing, and not being propped up by this over-leveraged, burdened property sector. And that is going to be a painful, and it is going to be a long process, and it is going to have a lot of bumps in the road. But in terms of a theme that you can trade in the here and now, I think that kind of transatlantic growth divergence of UK and Europe being struggling to say the least, and Canada and the United States proving relatively resilient and therefore likely to run with tighter policy stances for longer. That is the theme that I would be looking to get exposure to over the next kind of 6-9 months.
Yeah, definitely. And, if you do expand it into the wider globe, there are plenty of economies, particularly in the EM space, who are doing very well. There's no real signs of any danger coming from any of those countries, and those can be the ones that tend to tip first and lead everyone else down the road. But I'm still not expecting, I've been saying this all year, I'm still not expecting any big significant contractions in growth. Maybe a bit of bumping along the zero line, or things a bit tepid, but I'm not expecting to see anyone with minus 5% GDP on a quarterly basis or anything like that. And if we do get there, well, Mr. Pooh is going to be meeting Mr. Fan pretty quickly as far as rates go. So we're not playing who's going to end up in a fiery abyss. We're just going to play who's going to slow first, and I think that's going to be the trade, because at the end of the day, rates really are only going to start coming down to neutral levels where central banks feel comfortable holding them. We're not talking about easing per se because there are big economic problems. It's all about getting the rates down just to more manageable levels, shall we say.
Absolutely. And let's hope to God you haven't just jinxed the entire global economy by saying. Before Ryan gets a chance to put the kibosh on anything else, let's get on to some charts. Right. Now that the final nail has been put in the coffin of the global economy by my friend Mr. Littlestone, let's have a look at some setups. I want to start by looking at the dollar this week, as I alluded to in the introduction of the show. The greenback snapping an 11-week winning run on Friday, when most of those losses came. Actually, of course, that was the longest consecutive weeks of gains for the greenback against a basket of peers since all the way back in 2014. And actually, the fact that we've pulled back a little bit is not disastrous in any way, shape or form. In fact, a market can never go in one direction forever, and pullbacks are actually quite good to see, as they can clean up positioning a little bit and actually make the trend stronger in the longer run. And certainly I remain a dollar bull from where I'm sat. From a technical point of view, we held very nicely the prior year-to-date high, which is now support at 105.90, and also the bottom of the upward channel that's been in place since way back in mid-July. And of course, you've got some fundamental factors continuing to propel the dollar higher as well. The best of a bad bunch in terms of growth, as we just alluded to, higher for longer from the Fed, the long end selling off aggressively, and also the haven demand coming in from events over the weekend as well. So I'm still buying the dollar on dips, probably would continue to do so above sort of 105.5, maybe even down to the 105 handle. And to the upside, I think we really need to get our heads above this 107.20 region, the 50% retracement of the decline that we saw in the tail end of last year and the early part of this year. And if we can properly break free of that, then that could really kickstart the next leg higher in the greenback.
Yeah, I think this is a definitive case of where the moves have got to match the technicals, really. And we've had that high up in the 107s. It's held there. We've seen resistance afterwards, so it's potentially becoming a very decent top. I say potentially. We had similar price action when it was around that 104.50. We couldn't get through, and then we had the break. Again, it goes back to what I was saying earlier. How much more can the market take out of the higher for longer trade? All things get priced eventually. So if you get a couple more tests of that 107 area and it holds, then I'll be thinking, right, we've got a definitive top appearing in the dollar now. And you need to be careful with the upside in that instance. But then, it's going to take a lot to turn it the other way. So you probably find we enter a period of consolidation. You give you good two-way trading. You can hit levels into that 107 and buy it back on the dips, like you say, 106, 105.90, and then just see what happens and be prepared to go with whichever side we break thereafter.
Absolutely. As always, let the market lead the trade. Don't try and fight what's going on and what's beyond your control. What about dollar MEX?
Yeah, well, this one again, it's well in the dollar sphere, obviously, and it's been a big carry trade, as we know, and there's a lot of talk about whether the moves we've seen recently, particularly last week, is a possible exit from that carry trade, particularly in the face of this global rise in yields, which I think is being driven in no small part by US yields, obviously, and thus a stronger dollar. Now, as mentioned, this has been one of the big carry trades that a lot of people have been playing. And I think we've probably seen some of the latecomers to that party getting out in this move, and that's helped drive it higher. However, the longer-term carry traders are still well in the money in this trade and in terms of positioning, and thus they don't really have a reason to exit the trade just yet. Now, we've seen this bounce quite significant. We've had a couple of pieces of news. Banksy Co. helped things along by winding down their FX hedges and on the tech front, a significant bottom has now been put in place around that 1660, 1670 area. And then we've now got secondary support around 1740, which was a big level on the way back down, and also big resistance on the way back up. And as is often the case with charts like this, when something doesn't go down anymore, the only other way it can go is up. So we had that as I say, that bounce off those low levels, and we've pushed right up. We've not quite yet hit the 38.2 fib of the late 2021 highs. This and the 50 fib will be the important markers for the carry traders. If we start taking those out, then we're likely to see some of the longer term carry traders heading for the exit door, and then potentially see an acceleration higher in this pair. For now, we've got a huge level at the 1850. I know Blake's been talking about this today as well. That's contained this move up. So technically, playing nicely with the levels. You can see why it's an absolute doozy of a level. And in the near term, I think dip buying looks to be favoured here. But when we get into those higher levels, you're going to see people taking profits.
Absolutely. I think 1850 is pivotal here, as you rightly surmised. I think the only thing I would add is that we've seen hundreds of occasions before where if a carry unwind does really start to get going, then it can get pretty messy and pretty ugly pretty quickly. So if you are trading dollar MEX, then do bear that in mind. I think risk management, no matter what side of the pair you're on here, what side of the trade you're on, is always key, but is absolutely pivotal given the risks associated with the carry side of the equation.
Yeah, and you've got to remember again, like dollar yen, maybe even more so in this one, it costs you to be long this pair. So if you're going to be long, and people who will be buying it and going long in some of these moves, they're going to be quick to exit, particularly when it runs into trouble. Thus, you get those dips back down again, because they're going to be much faster in and out of these trades, playing it from the long side.
Absolutely. Right. Well, let's have a look at WTI. It was an awful week last week for crude bull, probably the worst week in a hell of a long time, actually. WTI down 8% or so. I think Brent fared even worse, down about 12% on the week. It was an interesting one because there wasn't really one kind of major catalyst you can pin to. I mean, the technicians would say we tested 95, couldn't break through and ran back to the other side very quickly. On the fundamental side of things, you had a big build in US gasoline stockpiles. That would have added a bit of pressure. And Russia also getting rid of their diesel export ban was a bit of an unexpected move and would probably have helped things along. We found some support around 82.50 last week into Friday's close. And then, of course, developments over the weekend have resulted in a big pop higher. I think the gap at the futures open on Sunday was somewhere around 5.5%. If you look at front month WTI, that's paired quite substantially. I think we're up around 2.5% at the time of recording, but WTI is now back above its 50-day moving average. Now, we need to wait and see where the market closes, but back above the 50-day moving average, you would say that would give the bulls a little bit of control in the short term. But I think some caution is needed here. And if people are going long crude based on a big rise in geopolitical risk in the Middle East, I think it's important and I sent this out on Twitter earlier, just pull up a map of the big energy infrastructure in the Middle East. The Levant region, Israel, where the current issues are going on, is not a big crude producer in any way. So I think the move higher that we've seen in the market today is more a reflection that the market is considering the risk of other countries perhaps being dragged into the conflict. If that does take place, then you would say that the case for further upside in crude is a lot more solid. But for now, I think I'd fancy selling into that pot, especially if we get a close back under that 50-day moving average tonight.
Yeah, I think you've nailed it there. I mean, it has moved through the text. I mean, we did get a little bit of a push through up through 95, but it didn't last. And we came back down to an old resistance and support point at 82.50, which long-term viewers know we've been talking about that one in the past. Again, it just nudged it through, maybe tried to tickle a few stops under level, but then we bounced again. I think you're right. It's always difficult talking about these sorts of situations and keeping it to a market slant. But these events, that area, Israel, Palestine, they don't tend to be lasting in a market sense. But I think you're quite right. The drag into other countries might be quite big, or maybe bigger this time than before, because we've got the ongoing spats between US and China, US and Russia, and everything else going on in there. So I think that the wider geopolitical sphere might have a bigger influence on this than it may do otherwise. But in terms of where we bounce from, I think rallies would likely get hit on this. I wasn't overly keen on why we were rallying so hard when we were, for all the reasons that were given in the market. So this pullback seems to be a sensible move in terms of all that. So I don't think rallies are going to last too long unless the geopolitical situation really, we see further risk off coming into this one. So I'll potentially more be a rally seller than a dip buy in this one.
Absolutely. And I think standard advice applies with this one in terms of all geopolitical events. They are unpredictable. We will see fast and unexpected moves in the financial markets. You will miss some of those moves. That is just the very nature of the beast. But there will be other moves that you are able to take advantage of. So again, protection of capital should take precedence over chasing things that aren't really there to be chased. What about JGBs? Lastly, your Japan obsession continues, Ryan.
Yeah, well, if it's hot in the news, we need to be aware of it, particularly for trading it. So, yeah, looking at 10-year JGBs, because while the level moves in the yen is obviously front and centre, I think the bigger risk facing the Ministry of Finance and Bank of Japan is this continued firefighting going on in yields. Now, naturally, the global pressure on yields, as we're speaking about, is strong here too. But then no other major central bank is running YCC. And this is a big part of the conundrum for Japan, as keeping a lid on these yields is going to become an ever tougher task if the economy and inflation holds up and they move towards the monetary policy easing exit door. So the higher yields go here, the more expensive it's going to become for Kishida to finance his next fiscal packages. Yet those packages, if they bear fruit, will encourage yields to rise also. So it's the proverbial rock and hard place as far as the Bank of Japan is concerned, and how they tackle this might becoming more important than their worries over yen levels. Right now, we're trading around the 0.8 mark, getting up towards the top of their top of the band of the YCC at 1%. And I think this continued pressure might force them to revise their yield curve control again in the coming monetary policy meetings, maybe widen it a bit more, give it a bit more room to allow it to roam, but they can't let it go too far or they're going to pile the pressure back onto the government in terms of financing costs.
Absolutely. And of course, Japan is running 250% debt GDP ratio, although you shouldn't compare a stock to a flow. I know I'm just doing it because it's a good example of how high their debt is. The key thing for me here is not only JGB yields, but also swap rates. I don't know whether you can actually access these without a terminal, but when I looked earlier, 10-year Japan swap rates were well above 1%, 1.05, 1.06, I think we were trading, which implies that the market is really starting to think about testing the BOJ in terms of the top of that YCC band. So, they've got a choice. Do they continue with the current bands, or do they widen them? And I would say that given the reason for widening them in the first place was given to markets as to prolong the sustainability of easing, basically saying we can do this for even longer, I would lean towards them widening them again rather than gearing up for a fight, but only time will tell.
Yeah, very much so. It is like fighting a fire with a water pistol, and they've been in that position for quite some time now. So they either got to get a bigger water pistol, or they've got to move the fire elsewhere.
Absolutely. Well, we'll see if they do get that bigger water pistol or not. Before we do, though, let's get into our plays of the day. Right, I want to look at the Aussie dollar this week, and if you're watching in Pepperstone's Melbourne office, then just turn off because it ain't going to be good news for you. The Aussie is a little bit similar to the euro, although probably better news than the cricket yesterday. Sorry, just had to get that. The Aussie dollar is a little bit similar to the euro of late, just been kind of going nowhere, really, consolidating in what's been a pretty tight range between this 63.5 and 65 level, and just hasn't really been able to break either way. I think the more telling thing for me is actually there has been plenty of fundamental reason for the Aussie to move higher. Particularly last week, equities had a decent weekly gain led by the more risk-sensitive areas of the market, things like tech, and also sentiment towards China has improved, yet the Aussie dollar hasn't managed to mount a significant recovery. And when you couple that with the RBA remaining relatively dovish last week, new Governor Michelle Bullock really not giving any hints towards further tightening, I do think we will eventually, this range will eventually resolve itself to the downside. So looking to be short the Aussie dollar here, stop relatively tight, just above the 65 handle, near the 50-day moving average, eyeing firstly another test of this 63, 65 level, but eventually I think we can probably get back down to the mid 62s, which was the low that we saw back in autumn of last year. Ryan, you're looking at what I was looking at last week.
Yeah, and I think it's time for some downside. So I'm going to take the baton from you, and well done. You really nailed this one last week with your long call. I've been getting bearish on this parent, or more so bullish on Canada over the last few weeks now, mainly on the back of the data that we've seen over there, inflation, the Bank of Canada turning a bit more hawkish. But the funny thing is, though, as much as I felt like I wanted to start shorting this pair, I keep finding myself buying it, and I did that last week as well. Pretty much about 10 minutes after we finished this show, I done a little scalp at 136.50 and ran it up to the highs. But now I want to look properly at the short side, and there's two areas I'm watching for now. In the shorter term, we're back below the trend line and 137 level, so that's my first area of interest. If we get a retest there and we hold it, then I'm going to be looking good for a tight short into that level. Now, if we went through there on a test, I'd sit back and let's see if we get a move up to scaling up towards those last week's highs, 137.86 and into 138, which is the next level I have up top. If I got in up there, I'll be looking at a stop through sort of 138.20, 25 through there. I'm definitely wrong. But for now, I've been wanting to short this pair, but I kept buying it, and now I'm looking again to properly get shorted.
Good stuff. I think dollar CAD is probably the only place I'd want to be short the buck at the moment. So, do with that information what you will. That does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me, and to our producer, Kyriakos, as well, for bringing this together as brilliantly as he always does. All three of us will be back with another show this time next week. If you've enjoyed the trade-off, give us a like on the video, drop a comment as well. Let us know how you're trading the markets, and all three of us will see you again then. Thanks for watching, and goodbye for now.